If you have ever heard index fund, mutual fund, ETF, and hedge fund used like they all mean the same thing, you are not alone. They are all ways to pool money and invest, but they are not interchangeable. Pick the wrong one and you can pay too much, trade the wrong way, or buy complexity you do not need. Welcome to Plain Money. I am Finn. In the next 10 minutes, I will compare index funds, mutual funds, hedge funds, and ETFs in plain English. By the end, you will know what each one is, how it trades, what it costs, and which type most beginners should actually use. Let us start with the big picture. All four are pooled investment vehicles. That means many investors put money together, and the fund buys a basket of assets like stocks or bonds. You are not picking one company at a time. You are buying a slice of a whole portfolio. First up, index funds. An index fund is built to track a market index, like the S&P 500. It is not trying to outsmart the market. It is trying to match it. That is why index funds are usually passively managed. There is no manager making bold stock picks every week. There is a system following a rule. That passive design matters because fees stay low. Many index funds charge an expense ratio between about 0.02% and 0.2% per year. You are mostly paying for the fund structure, not for expensive active decision making. For long-term beginners, that low cost is a huge advantage. Index funds also tend to be simple and diversified. One broad market index fund can give you exposure to hundreds of companies in a single purchase. That is why index funds are often the default recommendation for beginners who want steady, long-term growth without stock-picking stress. One trading detail matters too. Traditional index mutual funds usually price once per day after the market closes. You can place an order anytime, but it executes at the end of day net asset value. That is fine for long-term investors, but it is different from buying a stock in real time. Next, mutual funds. A mutual fund is also a pooled portfolio, but many mutual funds are actively managed. A fund manager and research team try to beat the market by choosing which stocks or bonds to buy and sell. Sometimes that works. Often the extra cost eats into the benefit. Because of that active management, mutual fund fees are usually higher. Expense ratios often land somewhere around 0.5% to 1.5%, and some funds cost even more. You are paying for people, research, and trading decisions. That can be worth it in rare cases, but for most beginners the fee drag is real. Mutual funds can still be useful. Some workplace retirement plans offer strong mutual fund menus. Some investors want professional management in a specific niche. But for many people, an expensive active mutual fund is a harder sell when low-cost index options exist. Like index mutual funds, traditional mutual funds also trade once per day after the close. So if you are comparing mutual funds to ETFs, do not assume they work the same way just because both are called funds. Now hedge funds. This is where the conversation changes completely. A hedge fund is a private pooled fund usually aimed at wealthy individuals and institutions. It is not a normal beginner product sitting in a standard brokerage app next to an S&P 500 fund. Hedge funds often use complex strategies, short selling, leverage, derivatives, and other tools most retail investors never touch. The goal is often higher returns, but the risk and volatility can be much higher too. These are not boring long-term savings vehicles. Access is another major difference. Many hedge funds require accredited investor status, which often means a high income or a net worth above $1 million excluding your primary home. So even if you are curious, most beginners cannot simply buy into a hedge fund the way they buy an index fund. Fees are extreme by retail standards. Hedge funds are famous for the 2N20 model, about 2% of assets per year plus 20% of profits. That is a completely different universe from a 0.05% index fund. High fees can be justified only if performance is consistently strong, and that is hard to sustain. So who are hedge funds for? Usually high net worth investors who already have a large core portfolio and want a small, aggressive slice managed with complex strategies. For the average beginner building a first investment account, hedge funds are mostly context, not a shopping list item. Finally, ETFs, or exchange-traded funds. ETFs are often described as a hybrid between index funds and stocks. Like a fund, an ETF holds a basket of assets. Like a stock, it trades on an exchange throughout the day. You can buy and sell whenever the market is open. That intraday trading is the biggest practical difference for many investors. If you want real-time pricing and flexibility, ETFs feel more like stocks. If you prefer simple automatic investing and do not care about intraday prices, index mutual funds may be just as good. Most ETFs are passively managed and built to track an index, which keeps costs low. Expense ratios are often competitive with index mutual funds. But do not compare fees in isolation. Some brokers charge commissions on ETF trades, while many mutual funds allow automatic dollar-based investing more easily. ETFs also come in huge variety. You can find ETFs tracking the broad market, technology, bonds, gold, international stocks, and many more themes. That flexibility is powerful, but it can also tempt beginners into overly narrow bets. A broad market ETF is usually the better starting point. So how do these four compare in one view? Index funds, passive, low cost, great for long-term beginners. Mutual funds, often active, higher fees, end-of-day pricing. Hedge funds, private, complex, expensive, mostly for wealthy investors. ETFs, flexible, usually low cost, trade like stock. The most common beginner confusion is index fund versus ETF. Both can track the same index. Both can be cheap and diversified. The real differences are trading mechanics, tax details, minimums, and how your brokerage or 401k offers them. In a taxable account, ETFs are often more tax efficient. In a 401k, you may only have mutual funds anyway. Another common mistake is assuming active must be better. Many studies show that after fees, most active managers underperform simple index strategies over long periods. That does not make every active fund useless. It just means beginners should not pay premium fees by default without a clear reason. Also watch minimums and account type. Some index mutual funds require a few $1,000s to open, while many ETFs let you start with the price of one share or even a fractional share. In a Roth IRA or taxable brokerage, that flexibility can matter early on. In a 401k, your employer menu decides what is available, so compare the lowest cost broad option there first. What should most beginners actually do? For a first long-term portfolio, broad market index funds or broad market ETFs are usually the cleanest answer. They are diversified, low cost, and easy to understand. Add bonds later if you want more stability. Ignore hedge funds until you have a much larger portfolio and real experience. Your week 1 plan is simple. Check what your brokerage or 401k actually offers. Compare expense ratios on one broad market index fund and one broad market ETF. Notice whether each trades intraday or only at the close. Then pick one simple low-cost option and automate your contributions. The win is not finding the perfect fund name on day 1. The win is choosing a cheap diversified tool and staying consistent. If this helped, subscribe to Plain Money for more beginner-friendly finance explainers every week. Comment with the fund type that confused you most, and watch our index fund, bonds, and finance basics videos next. The goal is not to memorize jargon. The goal is to pick the right tool and keep more of your returns.